Buying at the top and selling at the bottom? That ends today. If you've ever felt lost looking at crypto charts, this is your starting point. In this video, we'll break down technical analysis basics so you can read charts like a pro even if you're just getting started. Before we dive in, don't forget to like and subscribe for more beginner-friendly guides, trading strategies, and smart tools to level up your skills. Let's get started. 1. Understand candlestick basics. Candlesticks show price movement in time, displaying open, close, high, and low in each bar. A green candle shows price went up during the period. Red means the price has dropped down. The thick body shows the open and close price. The thin wicks show highs and lows reached. Short candles mean tight trading. Long ones mean volatility or heavy buying and selling. Candlestick shapes tell stories about traders' emotions and where price might go next. For example, a long wick on top signals sellers pushed back hard against price climbing. A long wick on the bottom shows buyers stepped in to support price at a lower level. 2. Learn to read chart timeframes. Timeframes represent how much time one candle or bar covers, from minutes to months long. Short timeframes like 5 minutes show fast trades, often used by scalpers or day traders. Longer frames like daily or weekly are better for spotting strong trends and big decisions. If you want to invest, use larger frames to see the overall direction and key trend levels. Short frames can confuse with noise, while longer ones smooth out and clarify big moves. Never rely on a single timeframe. Compare multiple ones to validate what the chart shows. Look for alignment in trend direction across frames for stronger confirmation and signals. 3. Spot support and resistance. Support is where the price tends to bounce upward. Resistance is where it faces downward pressure. These zones are not exact numbers but general areas where market reactions often repeat. A strong support holds the price from falling, like a floor under the asset's current price. A strong resistance keeps price from rising, acting like a ceiling in ongoing price movement. When support breaks, it may become new resistance, and vice versa in price reversals too. Draw horizontal lines where prices have repeatedly turned in the past or stalled before. These levels reflect crowd behavior, where many traders place buy or sell orders together. 4. Identify trends and trend lines. Trends show overall direction of price up, down, or sideways and shape your trading mindset. An uptrend forms with higher highs and higher lows, signaling increasing market confidence. A downtrend creates lower highs and lower lows, showing selling pressure and fading demand. A sideways trend shows consolidation, where buyers and sellers are temporarily balanced. Draw trend lines along the bottoms in an uptrend and tops in a downtrend to guide vision. Trend lines help you visualize momentum and spot breakout or reversal opportunities early. Do not force lines to fit the chart. Good trend lines naturally touch many key price points. 5. Recognize volume dynamics. Volume shows how much of a crypto asset was traded during a given period on the chart. High volume means strong interest, conviction, or confirmation of moves in price action. Low volume suggests hesitation, false moves, or consolidation zones lacking real pressure. Spikes in volume during breakouts signal stronger trust in trend continuation by traders. A rising price on falling volume can mean fading strength or upcoming pullback likely. Volume should ideally rise during new uptrends and fall in downtrends, losing steam fast. Use volume bars at the bottom of the chart and compare them across key price events. 6. Learn moving averages. Moving averages smooth out price action to show trends, reducing short-term volatility noise. The simple moving average averages closing prices over a period like 20 or 50 days. The exponential moving average gives more weight to recent data for faster reaction time. When short average crosses above long, it signals possible upward move or trend formation. If the short average dips below the long one, it may show reversal into bearish direction. Moving averages act as dynamic support or resistance when price interacts with the line. They help identify overall trend direction and filter out poor trade setups efficiently. 7. Understand relative strength index. The relative strength index shows if an asset is overbought or oversold on a 0 to 100 scale. Readings above 70 suggest it is overbought and may be due for correction or pullback. Below 30 means it is oversold and may attract buyers seeking value or bounce potential. Use relative strength index to gauge momentum strength and watch for divergence with price action direction. If price makes higher high and relative strength index makes lower high, it may signal upcoming reversal down. If price drops but relative strength index rises, it may show buyers gaining strength before a bullish move. Do not buy just because relative strength index is low. It can stay oversold for a long time in strong trends. 8. Watch for chart patterns. Chart patterns form repeated shapes that reflect crowd psychology and potential price behavior. Common patterns include triangles, flags, wedges, head and shoulders, and double tops. A bullish flag shows a brief pause in trend before continuing higher with renewed energy. A descending triangle often signals breakdown if price tests lower levels repeatedly. Head and shoulders pattern predicts reversal after an uptrend loses strength and momentum. These patterns require patience to form and should not be traded until confirmation appears. Use volume and candle behavior to confirm breakouts or failures before entering trades. 9. Use indicators sparingly. Indicators are tools that help analyze price but can confuse if too many are used together. Each measures different aspects: volatility, momentum, trend, or retracement prediction. Pick 2 or 3 that align with your strategy and time frame to avoid clutter and noise. Using too many indicators causes conflicting signals and indecisive or delayed trading. Learn how each works in detail before applying it to real money situations on charts. Test combinations on historical charts to see how they perform across market conditions. Never rely solely on indicators. Use them as guides, not decision makers in isolation. A clean chart with simple tools is often more effective than one filled with complexity. 10. Practice with real charts. Reading about charts is useful, but real learning comes from consistent hands-on practice. Use demo platforms or charting tools like TradingView to analyze crypto markets daily. Draw lines, mark patterns, and observe how candles behave near support or resistance zones. Practice spotting trends, volume spikes, and indicators across various coins and timeframes. Write down your analysis and revisit later to see how accurate your assumptions were. Track your progress in a journal to improve your confidence, timing, and pattern memory. Only through repetition will your chart reading skills become sharp and intuitive with time. Do not rush. Chart mastery is a long journey that rewards discipline and ongoing learning. Avoid emotional decisions and always wait for confirmation before making bold predictions. Studying charts daily builds your edge, giving you structure and calm in volatile markets. Some guess the market, others read the signals. What part of technical analysis clicked for you or still feels confusing? Drop your thoughts in the comments. And if this video helped you decode crypto charts with more confidence, don't forget to like and subscribe for more trading insights, strategy breakdowns, and tools to help you trade smarter. More coming soon.